They said Canada was too dependent on the US market. They were wrong. Canada has made a $214 billion trade pivot that put it at the center of new deals with Asia, Europe, and Latin America. This isn't just about numbers. Canadian agriculture, aluminum, and auto parts are now reaching markets Washington can't touch. While America puts up barriers and watches factories shift north, Canada is building real partnerships. The ripple effects are already hitting US supply chains, with some plants quietly planning moves across the border. So how did Canada pull off a shift this big? Canada just executed a trade move that sent shockwaves through North American markets. The $214 billion deal is not just a headline, it's a fundamental shift in who holds the cards. While US officials doubled down on tariffs and threats, Canada was busy finalizing agreements with Indonesia and the European Union. The United States, nowhere in sight. Indonesia is the standout. The Canada-Indonesia Comprehensive Economic Partnership Agreement, signed in Jakarta, wipes out tariffs on 95% of Canadian exports to Indonesia. This opens the door for Canadian wheat, potash, fertilizers, and more, products that US exporters now struggle to sell competitively. Bilateral trade between Canada and Indonesia has already reached $2.9 billion USD. And analysts expect that number to surge once the agreement is fully active in 2026. Indonesia's government called Canada a trusted partner, a phrase rarely used for US trade these days. Canada's Indo-Pacific strategy is about more than just one deal. Ottawa is targeting 40 countries across Asia and the Pacific, a region with a combined 4 billion people. Instead of spreading itself thin, Canada picked its battles, focusing on markets with high growth and strategic resources. Canadian mining and advanced manufacturing sectors are now positioned to tap into Indonesia's critical minerals, while digital services firms see new openings as Indonesia's economy grows at over 5% a year. Europe is the other big story. After the US imposed steel and aluminum tariffs under Trump's policies, the European Union fast-tracked talks with Ottawa. The result? Canadian aluminum producers now enjoy guaranteed EU market access, while American competitors face 25% tariffs on their exports to Europe, a direct response to US protectionism. This shift isn't just about market share, it's about perception. The EU sees Canada as a rules-based, stable partner, and that's attracting investors looking to escape the volatility south of the border. Foreign direct investment tells the same story. In 2024, FDI into Canada rose by about 9% year over year, topping $50 billion USD, while US numbers barely moved. Companies are reworking supply chains, using Canada as a hub to bypass American tariffs and unpredictability. This isn't just a win for Canadian agriculture, mining, and manufacturing. It's a signal that global players are looking for alternatives to the US, and Canada is stepping up. But there's a reason this opening was possible in the first place. Trump's tariffs changed the game in North America overnight. In March 2025, President Trump imposed a 25% tariff on Canadian steel, aluminum, and most other goods, plus a 10% tax on Canadian energy exports. Canada didn't just take the hit. Ottawa fired back with its own 25% tariffs on $30 billion CAD worth of US imports, targeting everything from Kentucky bourbon to high-tech electronics. The result was immediate. Canadian vehicle and parts exports to the US fell by nearly 23% in a single month. That's not a dip, it's a collapse. The auto industry felt it first. Major car makers warned that the new 25% auto tariff would add thousands of dollars to every vehicle's price. Business groups from Michigan to Missouri pleaded with the White House to reverse course, saying these tariffs would destroy jobs, but the dominoes had already started to fall. GM began construction on a new electric vehicle battery plant in Quebec. Intel scrapped plans for an Ohio chip factory and expanded its Montreal site instead. US farmers and manufacturers were next. Canadian retaliatory tariffs hit Florida oranges and Kentucky bourbon hard. Steel distributors in Pennsylvania lost contracts they'd held for decades. The North American Automotive Manufacturers Association said it plainly. The impact of the tariffs on vehicle prices has begun to fall on the backs of both consumers and manufacturers. Grocery bills climbed, store shelves emptied, factory layoffs spread in states that rely on cross-border trade. The investment numbers tell the rest of the story. U.S. foreign direct investment dropped 28% as businesses lost patience with unpredictable policy. Canada, by contrast, saw FDI rise by about 9% year over year, passing $50 billion USD. For the first time in over a decade, the OECD's Investment Confidence Index ranked Canada above the US for total capital inflow. Companies weren't just reacting to tariffs, they were moving to escape volatility. Canadian businesses wasted no time adapting. A pharmaceutical firm in British Columbia started negotiating with Asian buyers, cutting the US or out of the loop. A Montreal steel supplier warned American clients prices would double. Label pack printing slashed its US footprint, worried about rumors of 50% tariffs. These weren't stopgap measures. They were permanent shifts. The U.S. trade deficit with Canada hit 7.1 billion CAD, with exports to America down 15.7%. But Canada didn't just absorb the blow, they pivoted, locking in new deals with Indonesia, Japan, and the EU, while the U.S. watched supply chains unravel. Prime Minister Mark Carney summed it up. The old relationship with the United States is over. Factories planned for Ohio are now opening in Ontario. Japanese automakers are looking north for new production lines. The US isn't just losing deals, it's losing its grip on the region's trade. Canada's response to Trump's tariffs wasn't just defensive, it set the stage for something bigger. Canada is now at the center of a fundamental shift in North American trade, moving from a defensive posture to a position of strength. The difference is stability. Canada's regulatory environment gives businesses what they want: predictability and a clear path for long-term planning. Companies are making real commitments. GM picked Quebec for a new EV battery plant. Intel shifted chip packaging operations north. Amazon expanded its logistics network in southern Ontario, specifically citing faster zoning approvals. Walmart chose Alberta for an AI and robotics fulfillment center, pointing to stable data policy and less regulatory uncertainty. Energy costs are another factor. It's now easier and cheaper to build a clean factory in Ontario than in Ohio. Canada's steady energy policies and better raw material access, thanks to new trade deals, give it a clear edge. Meanwhile, U.S. infrastructure projects have stalled out. The constant threat of new tariffs from the White House has created chaos, and businesses are responding by looking elsewhere. North America's supply chain is diversifying across borders. Mexico is seeing growth in hubs like Nuevo León and Guanajuato, offering better build quality and faster permits. Canada's bridge building isn't just about Asia or Europe, it's about creating new connections across the continent. Asian investors are bypassing US-led frameworks, signing deals directly with Canada, Australia, and Brazil. Reliability is winning out over sheer market size. Trade flows are shifting. While 75.9% of Canadian exports still go to the US, that share is falling. Canadian firms are opening offices in Berlin, Jakarta, and Dubai, deliberately scaling back on US sales. US exports to Canada fell by over 1% last year. This reversal is significant. It shows Canada isn't just keeping up, it's pulling ahead. Supply chains are being rebuilt around certainty. Japanese automakers are scouting Canadian locations. European steel buyers are signing long-term contracts with Canadian producers. Even American companies are rerouting through Canada to escape their own government's unpredictability. These are permanent moves, factories and infrastructure that will last for decades. Canada's deliberate approach is making it the new trade powerhouse in North America. The $214 billion trade pivot is only the beginning. As the US doubles down on trade threats, more businesses are making the calculation. It's safer to look north. Canada's $214 billion trade expansion shows how quickly the balance of power can shift. While the US doubled down on tariffs, Canada built deals across Asia, Europe, and Latin America, drawing in new investment and rerouting global supply chains. The EU, Japan, and India all chose Canadian stability over American unpredictability. Factories are relocating, and investors are following the data. Do you think the US can restore predictability before its allies are gone for good? Or is Canada now leading North America's trade future? Drop your thoughts below. This story isn't finished. The global trade map is still shifting.